Well, good morning, everyone, and sorry for the brief delay there. It does take some time to get so many people onto a webinar. Welcome to the RSM Budget webinar as we review the federal budget for 2023 and 2024. My name is Andrew Sykes. I'm a partner in the Business Advisory Division of RSM, and I will be your host today as we are joined by our expert panel. I would like to begin by acknowledging the Ngunnawal people, the traditional custodians of the lands that I'm presenting on today. I would also like to acknowledge the traditional custodians of the lands on which each of you are living and working from today. We've had our team up all night preparing our free report. The RSM tax team has that released. I encourage you to download our free report, and one of my assistants will put a link in the chat box that you can use to download the report. A reminder, we are taking questions and we've got a Q&A session at the end of our webinar. If you put the questions in the Q&A function, they'll either be answered live or by one of our tax team who's assisting us today. Well, there was a generally well-received budget. There's some debate amongst the economists, so I think it's going to be really interesting as they give different opinions on the inflationary impact of it. Generally well received in the face of some economic headwinds domestically and abroad. A little surprising compared to what we saw in Treasurer Jim Chalmers' second budget last October, where we forecast a significant deficit. But this budget is focused on cost of living relief and establishing the government's credentials as responsible economic managers. The centrepiece of the budget from a spending perspective was Treasurer Chalmers' cost of living package, valued at over $14 billion. The Treasurer's plan will focus on a significant Medicare bulk billing boost, energy price relief for millions of households, tax incentives for electrification and energy efficiency upgrades, cheaper medicines, and increased job seeker payments. Of course, a big winner in the budget is anyone who will be receiving superannuation. The impact of same-day payment of super or payday payment of super is significant. And Industry Super Australia has said that aligning super with wages could give millions of Australians $50,000 more at retirement. For businesses, small business will benefit from energy price relief and unexpected revitalisation of the instant asset write-off scheme. In summary, it's a budget that continues to deliver on many of the government's pre-election commitments from both a payments and receipts perspective. The federal government is predicting a $4 billion surplus, which will be the first in 15 years since the last one delivered by Peter Costello. Why are we having a budget surplus? Well, it's a budget that's delivered into an economy that's continuing to grow, is benefiting from stronger terms of trade in the middle of a commodities boom. This is combined with a strong job market and rising net migration to give the government a very easy run into this budget. Despite this, there remains caution about international headwinds and some longer-term doom and gloom. Slowing economic growth is forecast, and we are likely to head back into deficit in the coming years. Now, we're going to have a look at the major highlights of the budget, and they will be presented by our panel of experts. Joining us today, we have Effie Zahos, David Pearce, Craig James, Katie Timms, and Liam Telford. So a panel of internal and external experts. So the first presenter we will have today is Liam Telford. Liam's National Tax Technical Director, RSM Australia, and has over 15 years of experience. Liam's experience ranges from working at the Australian Taxation Office to various Big Four accounting firms and BHP. Over to you, Liam, to give us a tax perspective on what this budget means.
Thanks, Andrew. So there are effectively four key categories of announcements that will impact business. There's obviously the petroleum resource rent tax PRRT reform, some targeted incentives for the emerging build-to-rent sector, implementation of the OECD's Pillar 2 project, and miscellaneous support for small business. It's probably also worth mentioning the additional resourcing afforded to the ATO for compliance activity. For example, the government will provide the ATO with additional funding for things like ensuring GST compliance, debt recovery, addressing tax evasions. And obviously these investments in the ATO are forecast to have a significant multiplier effect in terms of resultant tax collections. So turning to the PRRT reform, it effectively implements 16 recommendations from the gas transfer pricing and Callaghan reviews, expected to generate additional PRRT of $2.4 billion over the forward estimates period to 30 June 2027, and actually $3.5 billion over the entire period to 2049 to 50. The primary measure of those 16 is a cap on deductions for LNG projects that will limit the proportion of PRRT assessable income that can be offset by deductions to 90%. So it effectively brings forward PRRT receipts. There are a few specific aspects to that rule that I don't propose to get into unless anyone has some specific questions. But one of the key sort of aspects is that it won't apply until 7 years after first production to minimize the impact of upfront PRRT payments on the project economics. Other measures sort of constituting those 16 relate to transfer pricing or are of an administrative nature. They're nonetheless quite significant. There's been a bit of noise about the measures being too modest. Some of what was sort of anticipated in the newspapers, etc., went far beyond what the government's done. But in my view, a critical balance has been struck between the need to ensure a reasonable return for the community for the use of its gas resources and project metrics, i.e. not deterring further investment in future or existing projects, which could have a myriad of adverse consequences. Turning to build to rent, the reforms announced to encourage build to rent developments at a federal level, they follow the introduction of incentives at the state level. So you saw land tax and then transfer duty incentives recently announced in Queensland following similar incentives in New South Wales and Victoria. And broadly, these tax incentives for the BTR developers comprise a reduced managed investment trust withholding tax. So that comes down from 30% to 15%. So that can improve the IRR for foreign investment in these projects. That's important given capital intensity of these projects. And also the increase in the annual capital works deduction for eligible projects from 2.5% to 4%. So you go from 40 years to 25 years project life for depreciation, for want of a better term. Fairly modest impact on the budget, only estimated to decrease tax receipts by $30 million over the forward estimates period. Not sure it's really enough to influence the investment decisions of property developers, notwithstanding its welcome. And there's probably other areas of potential reform in that area, perhaps GST. BTR is typically input tax, so maybe making it GST free will allow the developers to claim GST on acquisition and construction of the projects. Thirdly, implementation of the OECD's Pillar 2 project, that's the global minimum tax rate. So there's actually a global minimum tax and a domestic minimum tax that are based on the OECD's global anti-base erosion model rules, both at 15%. I won't get too much into the technical, but basically the purpose of the latter, being domestic minimum tax, is to give Australia the first claim on a top-up tax where there's a low tax domestic income, so where the effective tax rate's below that 15%, so Australia sort of gets priority. The forecast receipts over the forward estimate period is only $370 million, which seem relatively modest for a project of this scale. There's also some corresponding funding for the ATO of around $110 million to deal with implementation, presumably from a sort of enforcement standpoint as well. And then finally, support for small businesses. There are a range of measures. So there's a temporary increase to the instant asset write-off, $20,000 per asset for small businesses, being aggregate annual turnover of less than $10 million. Not quite as good as the temporary full expensing that we've come to enjoy in recent years, but better than reverting to $1,000. The small business energy incentive, so a bonus deduction of 20% for the cost of eligible depreciating assets that support electrification and more efficient use of energy. And that's up to $100,000 of eligible expenditure. So it's basically capped at $20,000. And those two provisions will operate in tandem. There are also some changes to the GDP adjustment factor for pay-as-you-go and GST installments, basically reducing that to from 12% to 6% to help cash flow. That'll have a net neutral impact on the budget. And just a comment, although the instant asset write-off and small business energy incentive measures have sort of been dismissed as potentially not enough, the impact of the budget bottom line is actually quite significant, about $600 million combined. So they are quite material measures, notwithstanding the way they've been perceived.
Thanks, Liam. Some real benefits there going through to the business community, that sounds like. Next up, we've got Effie Zahos, editor-at-large for Canstar and finance commentator. You would have seen her on the Today Show, our favourite personal finance commentator. Effie regularly speaks with media across Australia, and not only is she a money expert for the Today Show, her financial commentary features in many of Australia's other best-known media outlets such as the ABC, News.com, Sydney Morning Herald and Daily Telegraph. Well, welcome, Effie, to give us a personal finance update. We just not hearing you at the moment, Effie.
That always gets me, keeping it on
Yeah.
mute. It was an interesting night. Unfortunately, there was no big surprises, and that seems to be the thing with budgets these days, doesn't it? Everything seems to be leaked out before the actual night. The big surprise for me and I'll just stay in my lane here on the consumer side, was obviously the Medicare boost, where GPs will be effectively paid 3 times for the bulk billing concessions. Look, I think from where consumers stand, there was a lot of the money going to welfare. And that's what you want to do. It's a typical Labor budget, as far as I could see. As you pointed out, there was this surplus. Maybe there's room for another surplus. I mean, when you look at some of their forecasts, and I'll leave this with the economists, but the iron ore price, I think they forecast at $60 a tonne. I mean, it's sitting over 100 now, so we could find a bit of a surprise. It was directed to where it was most needed. So the big winners, obviously, your single parents, that mentioned a little bit from Liam, small businesses, your low-income households, that energy relief. And this is something I know David was talking a little bit offline, but I did mention this morning as well. Very clever how this energy of up to $500. And again, I was trying to find more details about exactly who gets what, but that's still not out yet, because that depends on obviously the states as well and where you live. But that will be not given as a cash payment. Obviously, it's going to be coming off bills. So that helps with inflation. But on the other side, you could argue, is this enough? Have they actually spent enough? When you think about the stage 3 tax cuts, they're still staying. So someone on 200,000 will be getting a tax cut of around, what, $9,000. And you could argue that's so much more than what other people are getting that really need it right now. When you look at rent assistance, $31 per fortnight. Not complaining, everything is very helpful, but will that actually solve the rental crisis and affordability? I thought there wasn't much in there from the home loan affordability issues. And if there was going to be some type of positive, their forecasts there showed that the cash rate would fall. I mean, when you look at where they think their economy is going, it's a little bit scary. Next year, that's almost flatlining. But if the cash rate does get to that 3%, I think homeowners have some kind of light at the end of the tunnel. I've said it before that the CBA kind of does nail their forecasts quite well, and they're still standing by that peak. And Craig, this is your domain of where the cash rate is going to, the cash rate is going to stay at 3.85. Unfortunately, the budget did show also migration, population growth, and that's going to impact property prices as well. So on the one hand, we'll see some relief with rates, but will that actually stop property prices moving in the direction that first home buyers don't want to see? Maybe not so much. It was interesting and I'll throw this basically on the table, as far as welfare payments as a percentage of GDP, it's rising. Is this inflationary? Have they got the balance right? Obviously, from a consumer's point of view, I'd like to say it would have been great for more, but I think they've targeted really well. I think they've done a good balancing budget here that kind of meets both demands and have targeted it well for those who need it. One thing to note, obviously, a lot of these welfare payments aren't going to be available until the 20th of September, when they were going to be indexed anyway. So, it's not an instant relief if low-income earners are looking for something, in their bank accounts like next week. It's not going to happen.
Thank you very much, Effie, for that comment. And we've got some questions coming through for you. Just a reminder, if anyone does have any questions, you can type it in the Q&A and our panelists will be happy to answer them. You mentioned CBA, and we're fortunate enough to have Craig James here, Chief Economist for CommSec. Craig's worked in banking, finance and journalism for 40 years. And in addition to providing presentations to staff and clients, comments regularly on financial and economic trends. And as also, you would be familiar with Craig from the media. So Craig, quite a controversial one in many aspects for economists we're starting to hear.
Yes, economists, the debates. Yes, you get two economists in the room, you're likely to get 3 or 4 opinions, and that's certainly the case with the federal budget. The big balancing act in terms of the budget this year was trying to provide some cost of living relief to those people who really need it, but not being an inflationary budget, remembering the fact that what the Reserve Bank is trying to do is put up interest rates and slow down the economy. Our thinking is that they've done pretty well in terms of trying to get that balancing act. Now, in terms of the budget, remember it's only a budget. We all do budgets, family budgets, sort of work budgets and whatnot. We all do budgets, and we know it's based on economic assumptions, and things can change in a short space of time. Back in October of last year, the expectation for this year was a budget deficit of $37 billion. Now they're looking at a forecast of $4.2 billion. So that shows you how much can change in a short space of time. Now, to the economic assumptions, we think the economic assumptions are very credible. Look, they don't try and gild the lily anymore. So they make sure that the forecasts are very much in line with so the general view around the place. The next financial year, starting in July, the CBA forecast for economic growth is 1.1%, 1.5% by the government, and 1.25% from the Reserve Bank. So you can see a slowdown in the economy. Previous year was 3.7%. So we're going from 3.7% down to around about 1%, in terms of economic growth. Normal growth in the economy is around about 2.25%. So you can see we are going to have a substantial slowdown in terms of economic growth. Wages, we're looking at 3.4% next financial year, 3.5% from the Reserve Bank, 4% from the government. So again, very much in terms of very similar in terms of forecast. And the jobless rate, we're looking at 4.5%. So current rate is 3.5%. We're at full employment. We expect with a slowdown in the economy, fewer opportunities to be able to put on staff. And as a result, the jobless rate rising to 4.5%. 4.5% would still be a very low figure. And if anything, so we're probably being a little bit too conservative there as well, given the fact that the interest rates have gone up decisively over the last 12 months, and we basically haven't seen a movement in terms of the jobless rate. 4.25% for the government in terms of the jobless rate, the same for the Reserve Bank. So you can see the forecasts are very, very similar. We've got a budget surplus projected for this year of 4.2 billion, and we should focus on that. So that's a very good achievement. Can we thank anyone? Can we thank the current government or the previous government? Well, it gets down to the fact that sort of the population has been rising, and I suppose so we could have had the current government and the previous government restricting population growth, but they've kept the doors open. Population growth of so around about 2% this year. $400,000 in net migration. That's going to slow to 1.7%, so next year, but that's still very, very strong growth of population. The previous estimate was 1.4% population growth. We're now looking at 2%. So that's super important. There's more people coming to our country, so getting work, getting jobs, paying taxes, going out there and spending. The companies are getting that in, the retailers are getting in there, getting the revenue, they're having to pay taxes as well. So the contribution in terms of the budget bottom line is coming from individuals paying tax, it's companies paying tax, it's higher commodity prices and strong demand for our mining and energy resources as well. We think that they've done a pretty good job in terms of the balancing act, making sure that they spend a little bit of money, sort of putting the dollars in people's pockets that really need it, but without it being too inflationary. But there are risks. If you do put dollars in people's pockets, the fact that so you've got the energy relief, you've got cheaper prescriptions, you've got the rent assistance as well. You've got sort of so many things driving wages for the aged care, single mothers getting sort of an increase. all those have the potential to put dollars in pockets, to go out and being spent, and it's somewhat inflationary. So we know that there are risks in terms of inflation. We just don't think they're going to be realised. This year, the federal government has basically stayed away from stimulating the economy too much. Basically, it's only added in something like $1 billion to that $4.2 billion. So they're worsening it by $1 billion, which is hardly negligible. Next financial year, policy decisions add $12 billion to the budget bottom line. So that's where the risks are in the next financial year, that we have that stimulus coming through, and hopefully it's not going to make the Reserve Bank's job any harder. But overall, we would give it probably about a 7 out of 10. There's a few reservations that we have, particularly in terms of things like the lack of productivity announcements, the fact that population growth probably should be maintained at a higher level, and the stimulus that the government's putting in, $12.2 billion. If anything, it's a little bit on the high side, create risks for the economy. I'll leave it at that, and wait to panel discussion and questions for the audience. Thank you very much.
Thank you very much, Craig. That tension between the Reserve Bank and the government in terms of inflation and who's stopping it and who's creating it. But we might get a little more on that from David Pearce. So economically important this year. We've got two economists on. David is joining us. He's a director for the Centre for International Economics with over 30 years of experience in applying his economic reasoning and combining that with empirical and evidence-based quantitative techniques to advise clients. So a very good economist and well known to RSM. David, over to you for your opinion.
Thanks, Andrew. Well, I think, as Craig said, you can have two economists with at least 3 or 4 opinions, and I probably have several contradictory opinions in my own mind. I guess if the question on, is this budget inflationary? There's certainly nothing in this budget that will increase growth, so it's not inflationary in that sense. There's a lot of reshuffling going on. You're taking from one set of taxpayers and giving money to another set for very good reasons. I don't object at all to cost of living type measures for individuals that are struggling. As Craig says, there is a risk that it's inflationary. I think you have to be a little bit careful with claims that this will reduce the CPI. It's reducing the CPI as measured, but it does nothing to actually lower the underlying inflationary pressures in the economy. And I guess that's a fairly important point to make. One thing I always like to go looking for in a budget is, where are the long-term investments in the budget? Where are the things that pay off, not just this year, but that will pay off increasingly over time in years to come? And there's not that many in this budget. There's some small items, some things that are close to, I guess, our hearts here at the CIE. I mean, there's increased funding for a lot of measures in the Pacific, in our Pacific community. So it's a diplomatic and aid-based set of increases, couple of billion essentially over time. I think that's a very good idea. Good relations and growth amongst our Pacific neighbours are very important to the Australian economy, but it's a long-term investment, right? You won't see any particular outcomes from that immediately. And in fact, we may not know for a long time whether that's been successful. There is some increased funding to some research agencies, which I believe are very important to the Australian economy, but generally fly below the radar. There's some money has gone, for example, into marine science research, particularly around the Great Barrier Reef. This is a big climate change issue. I think that's money really well spent. But again, longer term measure. There are some biosecurity measures in this budget. Again, biosecurity generally flies below the radar for most Australians, although I'm sure many people, particularly if you live in New South Wales, observed what happened with bees recently, the Varroa outbreak and the burning of beehives and so on. That's biosecurity. The government is proposing to fund additional biosecurity measures, but they're also proposing to get the money from that from a biosecurity levy, the details of which are not entirely clear to me, but those sorts of levies are controversial because the question of, how do you, what's an appropriate basis of levying people for biosecurity? Do you levy the people that create the risk? Do you levy the people that get the benefits? Given that all Australians get the benefits, why not just pay for it out of taxes in general? So there's a lot of controversial questions that arise there. And I guess the final point to make, it intrigues me with every budget that we've had recently, we've consistently, in the lead up, underestimated the importance of our resource sectors to this economy. And in every budget, it's amongst other things, but particularly the contribution of company tax from the resource sector, which has substantively helped the budget. I mean, resource prices have remained high despite very pessimistic forecasts that happen in every budget. In every budget, the government says, oh no, these prices are about to collapse. And in every budget in recent years, they haven't. So the importance of our resources sector to the Australian economy, I think, is underestimated. And I think it creates a huge amount of sort of cognitive dissonance because a lot of Australians don't like the resources sector. It's a filthy, polluting sector, allegedly. Coal, where we make a lot of money, is not good for greenhouse, and yet it's really propping up a substantive proportion of the budget. So we really need to think about what that means. There is a view amongst some people that these resource companies are making really, really huge profits, hence the sort of the increase in the petroleum resource rent tax. But as it turns out, that increase is really, really small. It's effectively bringing forward tax that would otherwise have been paid. It's about $2 billion, which is less than what the government's getting off smokers, $3 billion in this budget. So there's some really interesting, I think, conceptual questions that we need to ask and understand as a nation about exactly what our attitude is to our resources sector, given how important it is. But really, Andrew, just in summary, I think there's nothing in particular in this budget that's reform targeted. There's no concepts or ideas about how we're going to improve Australia's productivity performance. The long run investments, of which there are some, but they're fairly low level. You have to dig down into, go past budget paper 1 into budget paper 2 and 3 and 4 and so forth. But I think on balance, it's a nice holding budget, but we'd really like to see what the underlying programs are that will return Australia to growth in the long run.
Yeah, terrific, David. I do acknowledge your comment there on the resource sector. Will be a very different budget with a lower commodities price. We're now going to be joined by Katie Timms, Director of Superannuation and Self-Managed Super Fund Services at RSM. So Katie has specialised for a long time in superannuation, and she's our expert on all areas of super, including admin, compliance and superannuation strategy. So Katie, a quick comment from a super perspective on the budget.
Yeah, it was a pretty nice quiet budget for us this year, Andrew, which we always like after the trauma of the 2016 budget. That was a very late night for all of us. As you did mention, really positive to see the alignment of superannuation payments for employees. From an employer perspective, look, we're going to have to see the changes they make to the superannuation guarantee system. It's obviously going to come with a really heightened risk of making a mistake and missing it. So we're definitely going to need to see some changes there. But from an employee perspective, we lose over $1 billion in super every year. So there's only a positive there from an employee perspective. The big one, though, was the one that was announced before the budget. We knew it was coming. We knew there was something. And that was the taxing or the additional taxing for individuals with superannuation balances over $3 million. I think the reality is for most people, no one really has a problem with paying a little bit more tax. Those that do have those balances are very well aware of the generosity of our superannuation system. The problem we've got with it and the answers we didn't get in the budget papers last night, the two big problems, the fact that number one, it's not indexed. So that number is flat. We talk a lot about inflation. We know the value of money. So that $3 million cap is going to be eaten away pretty quickly, and it's going to capture people that maybe in time aren't going to be considered, these high, super high net wealth individuals. The other big problem with it is the fact that it is taxing unrealised gains. So what we're seeing the government push towards is this idea of simplicity of an administration system, not equality. So we're taxing the movements in asset values, which is unheard of in the Australian taxation system, and is potentially, you know, going to capture people that probably shouldn't be having to pay this tax. So disappointed, but unsurprised that there weren't further, you know, announcements or anything in relation to that. More disappointing is that the consultation finished on the 17th of April. The forward estimates in the budget haven't changed from what they were originally announced, which suggests that they're probably not going to look to change that system. All we can do is hope the draft legislation sees something a little bit more positive. But overall, not too much for superannuation, but we've still got real problems with this $3 million cap and higher tax.
Yeah, thank you, Katie. And it's so often with the budget, the devil is in the details. So we are having policy and legislation by media announcement, and let's see what actually comes out. And it is creating a lot of concern. Now, so we're on to our Q&A now, and you can still send some questions through. We do have a bunch of questions, and we'll get started on those. And Craig, I'll kick off with you. We had a question coming through and saying, you know, assuming that the budget is correctly costed, and I'm sure once again you'd get disagreement on that, how much will it add to the debt of Australia?
Well, I suppose the positive thing, Andrew, is that because we've got a surplus for this year projected, and because the deficits that are projected for the out years have come down as well, that we're seeing a better situation in terms of net debt. So net debt, you know, sort of this year coming up is going to be 574.9 billion. So 575 billion for net debt in 23-24. Now, the projection was that was going to be almost 26% of GDP, 25.8% of GDP. It's now 22.3% of GDP. So for something like 3.5 percentage points as a proportion of GDP going to be taken off as a result of the improvement that we're seeing in terms of the budget bottom line. Everyone's favourite, you know, says to highlight gross debt, though. It should be net debt, but yes, everyone likes to talk about gross debt. Why? Because it's bigger, and we can talk about the $1 trillion debt that Australia has got. 923 billion is the deficit that's projected for 23-24. That has come down over time. It was almost 41% of GDP. Now it's around about 36% of GDP. So an improvement happening in terms of that as well. We only get above $1 trillion in debt, you know, sort of gross debt, to the 25-26 year. So it is improvement. I think we've got to put it in an international perspective as well. If we look at net debt, around about 20% of GDP, that's one of the lowest proportions of net debt of countries around the world. Countries like Japan have got 180% of GDP. UK, United States, around about 100% of GDP is net debt. A lot of the European countries around about 50 or 60%. So we're one of the lowest, you know, in the world, with countries like, you know, sort of Denmark and Norway and New Zealand. So the bottom line is we can pay, you know, so these interest bills relatively, you know, so easily. We are in a whole lot better shape fiscally than a lot of other countries around the world.
Yeah, thank you, Craig. So just while I've got you, we'll shoot the next one to you, and just paraphrasing a number of questions that have come through. I remind you, a lot of these questions, there should now be the link up there in our chat box. If you just follow that link or go to rsm.com.au, you can download our detailed report. There's a bunch of questions coming through, and I'll ask you first, Craig, and then David as the economist. And it's really around this cost of living relief and the impact on interest rates. Do we really have one working against the other? And is this budget potentially going to lead to more interest rate rises? So there's a whole bunch of questions on that area that are coming through.
The policy adjustments or the policy announcements add something like $12 billion to worsening the bottom line by $12 billion in the coming financial year, 23, you know, so 24. Now, if we look at that as a proportion of GDP, it's something like 0.4, 0.5%, you know, sort of GDP, you know, sort of it's not a huge amount. If it was a whole lot, it was a fair bit bigger than that, there would have been risks, more risks in terms of inflation. There certainly are risks in terms of inflation, because if you put some stimulus into the system, $12 billion you're putting back into the hands of the individuals, the likelihood is that they'll spend that money. And it's all about supply and demand determining price. I've learned nothing else in economics apart from supply and demand determine price. And if you increase the amount of demand and you're not increasing supply, potentially you're putting sort of prices up. I think what we are going to see over the next 12 months or so, there will be no shortage in terms of supply. So the supply shortages that we've been seeing, that's going to be rectified. So supply is going to be lifting over time. If that basically meets the higher level of demand, that means you're not putting any upward pressure in terms of prices. So we admit there's potential, there's risks associated with the fact that they're putting dollars into the economy, but we don't think the stimulus is enough to move the needle in terms of the Reserve Bank having to lift interest rates even further.
Oh, that's some very good news, hopefully. David, what's your views on that, mate?
Well, it goes against the grain to agree with a fellow economist, but I completely agree it's about demand and supply. And this budget per se potentially increases demand without doing anything on the supply side as a budget itself, right? I mean, as Craig said, other things will change the supply side. So I think the risk, so in theory, it's potentially inflationary. In practice, whether that turns out to be the case because of all these other things that are going on in the world, we don't know yet. And I think it's worth keeping in mind that our interest rate decisions are not entirely independently determined by our Reserve Bank. Right? It's determined by amongst other things, by what's going on in the world. And if you look around the world, every other Reserve Bank, whatever they call themselves, are doing exactly the same thing. Even that surprise decision that our Reserve Bank made a week or so ago that took everyone by surprise, actually the US and the UK did exactly the same thing on almost exactly the same day, and it wasn't really a surprise to anybody. So I guess we need to keep in mind that the inflationary pressures and decisions about interest rates in particular happen in the context of a global economy, which we have relatively little control over here in Australia.
Thank you, David. And look, stepping back, and really the commonality here and what everyone really wants to understand is their interest rate on their home loan. So, Effie, this is a real personal finance question. What are you seeing there and the impact on interest rates on home loans?
Yeah, and it does come down to, I guess, your hip pocket. Well, what's this mean for me with your mortgage, whether it's an investment loan or a home loan? I mean, looking at the Canstar data, we're seeing that there is a lot of movement with interest rates, regardless of what's happening with the RBA. We know the pain that homeowners are having right now. You've got your typical mortgage holder that's seen their repayments go up by about $1,200. We have seen record number of people refinancing in March alone. I think we're looking at about 22 billion was refinanced in March. The thing is, there is a lot of fixed rates falling down at the moment, which would be a reflection of the cost of funding. You've got some variable rate movements happening regardless of what's happening with the cash rate. I mean, a lot does come down to how much equity you have in the property as to what rate you could possibly get. The good news is that the average variable rate may be sitting around about that 6-point mark, 6.16. You can do so much better than that. There are plenty of lenders still under that 5% mark. And even some quick wins could even be, considering the pros and cons of locking in for a year, because if the economists do have their forecasts right, you could actually claw back some quick savings. I mean, refinancing from the average to the cheapest is about $500 or $600 per month that can come back into you. My biggest problem, and something that I think will come out soon, is the fact that there are a lot of mortgage prisoners, so to speak, because of that 3% buffer with refinancing home loans. So if you're looking at the rates at 6% and you've got that buffer at 3%, you're looking at can you afford to refinance at 9%? No, I can't, but I can get a better deal and be better off overall. So it'll be interesting to see if there is some movements there with that buffer for home loans that have to be refinanced. But still, what I'm seeing, cut a long story short, plenty of competition with interest rates on home loans, and record amount of people are refinancing.
Yeah, so it is, and that's been driven by that differential between the top rate and the best value rates that you're seeing in the market.
Yeah, so I can tell you now, 1 year's at 4.99, variable 4.99, 4.94. These are the cheapest in the market, the sharpest rates. And then you start getting, once you're locking in for 2 years at 5.24, still considerably lower to what most people would be sitting on if they had not negotiated with their existing lender at around 6% plus.
Yeah. So talk strategy, talk to your bank. Don't just accept the variable rate. Have a look at those 1 year fixed rates. And while I've got you, Effie, just crystal ball, where are you investing in the moment? Where would you recommend? Property, shares, fund management, or balance?
Well, I better not advise anything. I'm not a financial advisor, so I've got to take care there. But look, for me, in my age and where I am, I mean, a lot of interest in super, obviously. And yes, I completely agree with you, Katie. It was interesting to see that the super changes. I think moving forward, paying as you get paid is great, but it's from a small business, the word I'm hearing, it's going to be hard to accommodate that at this stage. Still a lot of teething. We are seeing an increase in the SG. That's going to happen. That will be a pay rise of 0.5%. But again, for small businesses, they're probably not going to like that. I think super funds had a shocking year last year. If you're looking at a balance fund, which most of us are in, we had a negative return. Looking at super ratings data recently, they're expecting it to be actually a great end of financial year. Balance fund probably closing at around 8%. Yes, I'm invested in exchange traded funds personally and shares directly as well. They've been volatile, but I think 2023, 24 will be probably a little bit better than 22, given inflationary pressures are easing, but still plenty of volatility. And I think the old age, diversification is the best way to go. But as for those of us in super and interested, I would see that the end of the financial year here will be much better returns than what we saw last year.
Yeah, thank you. And we keep on to some sound advice. We keep on talking about super, and certainly going to be some uncertainty moving forward with super. Katie, this notion of taxing unrealised gains, have you seen that anywhere else in the world?
From what I'm aware of, in 2022, there was a proposal in the US. They called it the billionaires tax. Now, there was an implication in that they might be taxing unrealized gains for individuals with family wealth of over $100 million. So it's fairly different to what we're seeing here. I'm not aware of anywhere else in the world that taxes this concept of unrealized gains, because you haven't actually made any money. So, it's a disturbing step that the government's taken on this. I know why they've done it. They've done it for simplicity, because they're trying to say, well, let's make this easy. It's only going to hit this 80,000 people. The reality is, some of the modelling that has been done, that number's going to grow to 500,000 people. So for those in their 30s, the $1 million, at $3 million is only going to be worth what we see as $1 million now. So that number is going to grow. So yeah, look, not aware of, and again, happy for anyone to correct me, not aware of anywhere in the world other than it being floated in the US last year, and it got a fairly unpopular response.
So you did mention that, and we've got a question. You mentioned the lack of indexation on the $3 million. Has there been any modelling done? And this is what the question is, probably coming from someone who's a bit younger, is that someone at age 25, they're going to exceed that potentially and get caught up in what is meant to be a tax on the wealthy.
Yeah, so look, we haven't done any. There's a lot of moving parts, but the SMSF Association, so they've put a fairly strong submission forward. They have done some statistics, and they do believe that we're going to exceed 500,000 people being captured by this in the next 20 odd years. So we're not just going to see this 80,000 top number of people. We're going to see a fairly significant number start to creep out to that, because we're still going to continue to see inflation. Our money isn't going to, be worth what it was. So it's a really big concern on that one. It's going to capture the 30-year-olds, the 20-year-olds who are making plans for their retirement.
Yeah, thank you. So that we've had question on the mention of the buffer there, Effie, in loans, and concern that would increase consumers' borrowing capacity. Is that the case, or is it more relevant to allow people to actually refinance what they've already got?
Yeah, more so refinancing, because you're in a situation now whereby with rates gone higher and you put up that 3%, you are not able to refinance to a loan that may be even more competitive. So definitely agree with that. If it was a blanket approach, probably not a smart move, but it is preventing a lot of people from refinancing to an interest rate that is actually lower, because that 3% mark is putting them out of their borrowing capacity. So yeah, purely just in refinancing.
Yeah. So, Katie, if I could come back to you on super, we are getting a bunch more questions through on this. Do we actually have a start date for it? And is there any talk about a tax deduction for losing assets? I mean, if your assets drop after you paid tax, what's going to happen?
Yeah, so this one's due to commence on the 1st of July 25. So we have got that time. You know, we are really waiting to see legislation on this before we tell anyone don't panic and let's not sell assets and let's not do anything right now. The way the legislation or the way the proposal has been drafted is that you are taxed on the increase. If there is a decrease, then you are entitled to a carry forward loss on that measure. So, you know, there's no tax refund issued. You pay the tax. If it drops, you do get a carried forward loss that can be offset against future. Always questions around that. What happens if you fall under the $3 million? Do you fall out of the system? You know, which was how the original proposal was worded. So still some concerns around that, but there is absolutely a measure for a carry forward loss on a reduction of assets. Just have to see how it's going to play out in reality.
Yeah, very difficult system to contemplate. You could be over 3 million, pay tax, and then the asset values drop. And yeah, seems to be very, very harsh. So there's been a question come through for the economists. There was a mention of a $12.2 billion stimulus. Can we just get an elaboration on what that actually means? I think that was you that mentioned that, Craig.
It basically means that there's policy measures that are being taken by the government that worsens the bottom line by $12.2 billion. So it's $12 billion rather than 12.2, but, you know, sort of policy decisions have made the budget deficit or budget surplus, you know, sort of, we could have been getting a budget surplus closer to 5 rather than 4 had it not been for the government this year spending around about $1 billion. So policy decisions have basically made the situation a little bit worse this year. Next year, 23-24, it's $12 billion in policy decisions that have been made by the government. That's putting stimulus in terms of the economy. Looking further out, it's $5.4 billion in the next year, and then $2.5 billion, you know, so the year on. So it's not super substantial. $12 billion is around about, you know, so half of 1% of GDP. So we're not putting a lot of dollars in the system, but we are putting dollars in the system, and that's why, you know, sort of as you know, sort of my colleague, you know, sort of has been saying, you know, sort of there's risks involved. You know, so your dollars in people's pockets, they may be spent, and that money has come from the government, you know, through various means. The energy subsidy, you know, so things like, you know, sort of childcare, cheaper prescriptions, single mothers benefit, wages for the aged care, a whole range of things where, you know, so the dollars coming through, and electrification as well, benefits for the small business sector as well as for individuals if they take up those options of getting rid of gas, say, and getting, you know, sort of cooktops, electric cooktops, or electric air conditioners rather than, you know, sort of something else.
Yeah, increasing demand for electricity, which leads to my next question to David. We've got the rebate there in the budget, but are there any other indications of the government keeping their election promises to reduce energy prices?
I think, well, not particularly in the budget. I think what, as you know, over the past little while, the government's put various caps on energy prices. I think they're trying to keep their promises in that way. They've stopped them rising as fast as they might otherwise have, but they're not reducing yet. And I guess the point here is that this is really a long-term issue, that what's going on in electricity prices in particular are several different forces interacting. I mean, one is just global commodity prices, the price, you know, at which essentially energy pricing in Australia is export parity because we're an energy exporter. But there's also the transition we're trying to make. We're trying to do a very, very large transition from from a fossil fuel-based energy system to a renewable energy system, that requires real resources. It requires real investment, and it will have an impact on costs in the short and even the medium term. But in the long term, the hope is that we'll be better off as a consequence because we reduce the probability of climate change. And so there's a real balancing act there. You can't look at energy prices, I think, and other transitional costs of climate policy independent of the expectation that we're improving our well-being a long way in the future, right? So we understand that we have to have short-term transitional costs in order to achieve a long-run improvement in the climate. And the long-run improvement in the climate may never actually appear in the budget, right? So a lot of it will be off-budget type items. So I think it's a difficult promise they made to reduce energy prices. It's not happening yet, but it's possible that it could happen in the medium to longer term. I think you're on mute, Andrew.
There you go. We've only been doing this for 3 years. Need a little more practice. Finally got caught on this. Katie, either Katie or Liam, as our tax experts, we had a couple of questions coming through on the deductible limit for superannuation of 27,500. If we are going to be paying more tax in super potentially, do you see that there will be a raise in that 27,500?
Well, look, there's probably two ways we can see that increase happen. One is indexation. So that is built in. If we see the increase we need under average wage increases, that's assessed in December. So if we see that in December 23, we could see an increase in that cap. I would be incredibly surprised if this government would do any changes outside of that. It's not a particularly friendly government for superannuation in general, particularly for those trying to boost balances. So outside of the indexation, I'd be really surprised to see any changes that they make to it.
Happening again, Andrew.
Over to you. Do you see? We've mentioned that this is short of reform, this budget. Do you see the tax system requiring further review other than what we've got on the agenda?
Yeah, it's a good question. It'd be good to get some insight from the economists on the panel. Personally, I'd like reform to be considered in sort of probably 4 key areas: taxation of trusts, payroll tax, GST, and the cash or black economy. So with respect to the taxation of trusts, I just think it's getting too complex. There's a plethora of case law and administrative guidance that taxpayers and practitioners are trying to grapple with, which is becoming exceedingly difficult. For example, Section 100A. We saw the possibility of the government's policy around taxing family trust-like companies canvassed prior to the last budget, but nothing's been heard of since. The government would, of course, need to be very careful in that space, as I appreciate it's very sensitive, bit of a political no-go area. Payroll tax, I don't think a reversion to the sort of federal model pre-1971 would be the worst idea. While sort of ostensibly there's a large degree of uniformity across the states and territories, variability in rates, for example, just over 1% in regional Victoria, up to almost 7% in ACT. The variability in concessions and exemptions on offer, thresholds, and even the administration of it make it difficult for employers to effectively comply and may even suppress labour mobility across Australia. GST reform, another popular topic. There are a lot of studies out there around revenue neutral switches from inefficient taxes like income tax towards consumption taxes can actually increase GDP. However, the move towards consumption taxes also disproportionately affects lower income households that spend a higher portion of their income on consumption. So the compensation mechanisms that are implemented need to be carefully considered. Not everyone's going to win from that sort of reform, but the most vulnerable need to be protected, absolutely. And then just finally, in relation to the cash or the shadow or black economy, the ATO has actually estimated this accounts for over $12 billion or approximately 30% of the total tax gap in the system. It's pretty staggering, especially when you consider sort of the government's obsession with multinationals who account for a relatively minuscule portion of that tax gap. Support we saw in the budget for the extension and merging of the Serious Financial Crime Task Force and Serious Organised Program announced in the budget, probably a good starting point, as is the enhanced data matching work the ATO are doing around areas like cryptocurrency, electronic distribution platform operators like Uber, etc., and rental properties like compelling the provision of property manager data, etc. So that's sort of in motion.
Yeah, and that's pretty much, you touched on increased compliance and data matching from
Exactly.
the ATO. That's a given as systems get more sophisticated. We are just about out of time. If Craig and David and Effie, if you could just give your top idea for any reform that you would have liked to have seen in the budget that's not there. We'll start off with you, Craig.
Yes, I go ahead with GST reform too. So I'd agree with that. I think, well, if you look at, sort of proportion of people 18 to 30, sitting in our economy, it's basically at an all-time low. So we have got an aging of the population. It is something that's going to further create structural problems in terms of the budget unless we deal with it, now. So we can't put off tax reform. We've got to, put that on the agenda. I was a bit disappointed we didn't see something about the black economy this time around as well. Seems to be every year you've got the tax office winding back and they're getting more revenue and a crackdown on the black economy. We didn't see that this time around. But GST, well, let's have a flat rate of income tax at say, 25, 30%, 30 cents in the dollar, and let's have a 15%, GST. And GST right the way across the board, a comprehensive, GST rather than having, the exemptions. But what we've got to do is encourage more people to come back into the workforce and also to stay in the workforce. And because the baby boomers, of which I am one, we're getting older and older and moving further away from the job market. If we've got incentives to stay in the job market, so that will be encouraging for the longer term health of our fiscal situation in Australia.
Excellent. Thank you, Craig. David, anything to add to that?
I agree with Craig. I mean, tax reform is clearly an issue that's been building up for a long time. I mean, it's interesting, people talk a lot about the black economy. The black economy might just mean people who are taking fairly simple measures to take themselves out of the tax system because it's too complicated, right? I mean, we've already heard a couple of things that are just mind-bogglingly complicated. It's easier for people to take themselves out than to work out how to pay tax. So tax simplification and reform really deals with that. And I guess I would like to see from a Labor government, good old-fashioned microeconomic reform like we saw under the Hawke-Keating governments. That was a very, very successful set of reforms, brilliantly implemented, but we have no real conversation about that. Our productivity performance is shocking in this country. What are we going to do about basic microeconomic reform, which would start with some core regulatory reform, of which there's a very, very big long list you can find anywhere if you Google it. But government regulations creeping up are a big part of that potential microeconomic reform, which we could undertake.
Yeah, excellent. And Effie, any final words before we wrap it up?
I would just have to echo the sentiments on tax reform, way long overdue there. And also this little bit of putting out some fires rather than fixing the structure. I think we are long overdue for that. And I was disappointed that nothing was done really for seniors and working as well, and the loss of pension. I know national seniors have been calling for that for such a long time. And again, that falls under your tax reform. And also just disappointed on strategy with trying to work through home loan affordability and rental crisis. Again, giving payments is a short-term solution, much welcome, but not really anything in the policy there to really fixing that. And the help to buy, radio silence on that as well. So yeah, affordability and tax reforms.
Yeah, okay. Well, we are now out of time today. I'd like to thank everybody who's attended our webinar and our panelists. Pretty interesting budget compared to previous years. One that seems to be short on thought and strategy, all about economic management, and it really doesn't give you a reason to vote the government out. So typical of what we see in budgets now. You can get more detail in our report, which is available at rsm.com.au, and there will also be a recording of the webinar available. Thank you, panel. Thank you, everyone, for your time today.